Let's jump right in. If you are a focused learner looking to reverse engineer the mechanics behind an absolute market powerhouse, well, you are in exactly the right place. In today's explainer, we're deconstructing the raw financial data of Interactive Brokers Group, ticker symbol IBKR. We're going to pull apart its core metrics, its margins, and its valuation to see exactly what makes this financial engine roar.
Okay, let's dive into this. 2,154.87%. Just let that sink in for a second. That staggering figure is IBKR's total return over the last 15 years. It is a completely jaw-dropping metric that instantly tells us we aren't just looking at a successful company. We are analyzing an absolute compounding machine. But the real question for us is, how did they actually do it? And more importantly, is that engine still running today?
To answer that, we're going to follow a really clear roadmap today. First, historical performance and returns. Second, revenue and profit growth. Third, financial health and margins. Fourth, the dividend story. And fifth, valuation and fair value. Starting with Section 1, historical performance and returns, the track record of a winner. Let's look at the exact price action that built up that massive 15-year return. When we break down the yearly returns from 2017 to early 2026, you can see the journey hasn't been a perfectly straight line. There's been some periodic volatility. Notice the dips in 2018, 2019, and 2022. But look at the sheer scale of the green years that really anchor the stock's long-term compounding. In 2024, the stock surged an incredible 114.43%, followed right up by a 46.37% gain in 2025. These explosive blowout years are what carry all the heavy lifting for long-term investors. Unless you think this is purely some historical success story, look at the data leading right up to April 2026. The stock is currently sitting on a year-to-date return of 20.78%, with a blistering 30-day momentum of almost 22%. This proves IBKR isn't resting on its laurels. It's a current, active market mover with serious momentum behind it right now. Moving to Section 2, revenue and profit growth, uncovering the growth engine. What is actually fueling these massive price surges? Let's look under the hood. This brilliantly illustrates the foundation of all that momentum. Here's the compound annual growth rate, or CAGR, for IBKR's revenue across a few different time horizons. We have a trailing 12-month growth of 12.86%, a 3-year growth of 27.77%, and a 5-year growth of 30.77%. Sustaining double-digit top-line growth over half a decade in the highly competitive brokerage space is a huge testament to their operational scaling. But honestly, it gets even better when we move from the top line to the bottom line. Compare these net income growth rates. We're looking at a 3-year CAGR of 31.61% and a 5-year CAGR of 32.29%. These numbers are almost identical, which is incredibly rare. It shows that IBKR is a relentlessly consistent, highly predictable, profit-generating machine. They aren't just growing sales. They are translating that growth directly into cold, hard profits at a really aggressive, reliable pace. That brings us to Section 3, financial health and margins, checking the vital signs. Rapid growth is fantastic, absolutely, but only if it isn't built on a fragile, over-leveraged foundation. So we need to check those vitals. Okay, 18.59%. This is the company's return on equity. I really don't want you to view this just as a static textbook metric. Think of this as the efficiency rating of IBKR's internal engine. For every dollar of shareholder equity, they are generating nearly 19 cents of profit. That is a highly efficient, active mechanism for compounding shareholder value year over year. Now, the data does show a debt-to-equity ratio of 5.73, paired with a current ratio of 0.98. While a debt leverage of nearly 6-to-1 might give a traditional retail investor a mild heart attack, it's important to understand the context here. For large financial institutions and brokerages holding client assets, utilizing leverage like this is pretty typical of their business model. Still, as focused learners, these are absolutely vital risk metrics we must monitor to ensure long-term stability. Assuaging some of that risk, though, is their expanding profitability. The current net profit margin sits at 9.01%, which is actively beating its own 3-year historical average of 8.39%. So the crucial point is this. Not only are revenues expanding rapidly, but the core business operations are actually becoming tangibly more profitable and efficient over time. Let's transition to Section 4, the dividend story, the compounding paradox. When I dug into the raw data for IBKR, I found a fascinating dynamic where the surface-level numbers hide a much deeper truth.
Now, what's really interesting here is the sheer juxtaposition. If you just screen stocks for yield, you'd probably glance at IBKR's tiny 0.41% surface yield and walk right away. But you'd be missing the real story. Look at the underlying growth. The 3-year dividend compound annual growth rate is a lightning speed 47.36%. They are hiking their dividend payouts so aggressively, it's just that the stock price has grown so fast alongside it that the current yield looks deceptively small.
And here is the fuel for those future hikes. Their payout ratio is a highly conservative 14.35%. This means they are only paying out roughly 14 cents of every dollar of earnings as dividends. That leaves the company with an immense financial runway. They can afford to reinvest heavily into their platform while simultaneously continuing to aggressively hike that dividend for years to come.
Which brings our narrative perfectly to Section 5, valuation and fair value. What is it worth today? We've seen the historical dominance, the underlying profit engine, and the healthy margins. But the ultimate practical question for you right now is, what is the true intrinsic value of this stock today?
To figure that out, the data relies on a discounted cash flow or DCF model. For those new to the term, this is simply a financial valuation method used to estimate the true intrinsic value of an investment based on all the cash it's expected to generate in the future, discounted back to today's dollars. It is literally the gold standard for value investing.
So let's rapid fire what the DCF model is telling us. The last market close price for IBKR was $77.59. It trades at a PE ratio of 33.30. But based on its cash flow generation, the fair value price, the actual intrinsic worth of the stock, is calculated at $174.35. Draw your attention immediately to that massive gap between the $77 current price and the $174 fair value.
That massive gap we just looked at represents your margin of safety. This is a foundational principle of investing where you only buy an asset when the market price is significantly lower than its true intrinsic value. It acts as a crucial buffer. If the future projections are slightly off, or if the broader market experiences a sudden downturn, that built-in discount protects your capital. And the data-driven verdict of our entire deconstruction culminates in this number. IBKR currently offers a massive 55.50% margin of safety. According to the cash flows, the market is pricing this high-growth, highly profitable dividend-hiking engine at less than half of what it's fundamentally worth. We've unpacked the historical compounding, the double-digit growth engine, the reliable margins, and finally, a valuation gap that is incredibly hard to ignore. So, leaving you to look at the facts directly from the source. With a 55.50% margin of safety sitting in front of you on a proven market winner, what is your next move? Keep learning, keep analyzing, and I'll see you in the next explainer.